Welcome to episode 19 of the Visionary Investor Podcast. Today I'm excited to talk about the technology sector. Now there are 11 different sectors in the stock market, and you actually can track sector performance through ETFs. So I'm looking here at the SPDR ETF. The ticker symbol is XLK, and that tracks the technology sector of the S&P 500. So we're looking at the largest 65 holdings in the technology sector of the S&P 500. Now, the first thing I notice here is Apple makes up almost 24% of this entire ETF. And you can see on the screen here, we also have Microsoft, 23%, NVIDIA, Broadcom, Adobe, Cisco, Salesforce, etc. So I'm gonna do something unique here. I'm gonna actually compare Apple to this ETF. Now, Apple makes up a large percentage of this ETF, so we would assume off the bat, if we're looking at the correlation of Apple compared to XLK, we should see something that's highly correlated. And that's accurate when we're looking at all returns over the past 5 years from a monthly standpoint. And what we see here is based on all returns, Apple and XLK have a correlation of 0.87. However, when we look at a correlation of negative returns only, we notice that Apple and XLK have a correlation of 0.38. That is a low correlation. So what's going on here? The 64 other holdings in this ETF actually are making a large impact on this ETF because we're noticing here that Apple actually is not highly correlated. In fact, has a low correlation compared to the rest of these stocks in this technology sector. Now, this is really important to note because you're going to notice here that Apple is not falling as much or as drastically as when XLK falls, and vice versa. It's not happening at the same time, and that's what a low correlation is going to show you. I also looked at the curve of monthly distributions over the past 5 years for Apple, XLK, and a few other top companies in this ETF. And I noticed an interesting trend. So Apple had a skew, which is the extent to which distributions are symmetrical. So we're looking at the outliers essentially of a return distribution. And I also looked at kurtosis, and that measures the shape of the curve. Kurtosis, if we're thinking of a normal bell curve where you have 3 standard deviations of the mean to the right and 3 standard deviations of the mean to the left, that is a normal distribution. Based on calculations, if you have a 3.0, that means you have a normal distribution, and it's called mesokurtic. Apple's distribution showed 2.19, which shows that it's slightly platykurtic, and this means that there's less peaked distribution. So we're looking at a little bit more of a flat distribution, and I'm pulling this up in front of me right now because it's really interesting to look at and compare it to XLK. XLK had a 2.14 kurtosis, which means they're kind of similar, but what we notice is there were 20 times over the past 5 years that Apple's returns were between 6% and 12%. When we're looking at XLK, there were 17 times that XLK's returns were between 3% and 6%. We've noticed that when Apple has increased over the past 5 years, the largest of its increases are greater. Next, when we look at the skew, Apple had a negative 0.18 and XLK had a negative 0.31. So what does this mean here? The more negative skew, the riskier an investment is. Why is that? Because there are more outliers that are negative. And if we look here, there were 5 times over the past 5 years, based on monthly returns, that XLK had a negative 9 to negative 13% return. When we look to Apple, in its furthest section to the left, there was only one time that Apple had a negative 14 to negative 20% return, but we do see that there were 10 times that Apple had a negative 7 to negative 14% return. And there were 10 times where XLK had a negative 5 to negative 9% return. Now, this is clearly offset by positive returns because if we look at XLK from a broad perspective, the annualized return was about 17%. The annualized return of Apple was about 25%. When we look at risk, which is measured based on downside standard deviation, we also notice something very interesting. XLK, even though it was made up of 65 different holdings, had a risk of 12.5%. And that gave it a risk-adjusted return slightly under 1 of 0.92 based on the date of this recording. Apple had a risk of 15%. So the risk-adjusted return here was actually higher than XLK. It was 1.3. You're adding 64 other companies into this ETF, and you're not actually reducing your risk much. And from a risk-adjusted return standpoint, you're not actually performing better. I think this is a classic example of showing you that having more stocks doesn't necessarily mean you're more diversified, and it doesn't necessarily mean that you are going to be able to weather storms better, and it certainly doesn't mean that you're having a stronger risk-adjusted return. So in my opinion, having a bunch of companies with small weights, whether it's 0.15 or 1% or 2% of a portfolio, really makes it difficult to outperform and to have a strong risk-adjusted return. Because at the end of the day, how much research are you really doing on those smaller companies? And even if you're using a financial advisor, it's important for you to help lead the conversation. Because by understanding more about different sectors and then specific companies in those sectors, you can use and leverage your industry expertise and your life experience and knowledge to find visionary companies. So what do I mean by that? Well, when we look at Apple and we're comparing it to other technology stocks, we're noticing that it's generally outperforming, and it has a large percentage of this ETF because it's based on market cap. Apple's clearly doing things right. Aside from having an incredibly strong brand loyalty, if we take a look at Apple from a fundamental perspective, we'll notice growing earnings per share generally year over year, a strong management team. If we look at ESG ratings, we're looking at fairly strong ratings there. And even further, Apple does an amazing job of managing their cash, and you can especially see this how they handle their cash around recessions. Very, very fascinating. Not many other companies that I've seen so far are doing a similar strategy. On top of that, because Apple has so much cash, I believe they have one of the largest buyback programs, and by buying their shares back, they've been able to help increase their stock prices, especially during difficult times, or when maybe fundamentals are strong and Wall Street is kind of causing the stock to fall. So it's really interesting when you look at it from a long-term perspective, because Apple's doing a lot of things right, and they have been doing a lot of things right. Not every technology company actually performs well, even though the technology sector has done very well over the past 5 and 10 years. So it's really important to find visionary companies like Apple that align with your specific goals. And if you have a financial advisor, they may be able to do the research for you, but you still want to be a leader in the conversations, because at the end of the day, you can leverage your knowledge and you can leverage your expertise to find the best stocks for you, but you need to have that knowledge and understanding of the stock market, how it works, how to find strong companies, and then you can make suggestions to your advisor. You can work alongside with your advisor to outperform the market. You'll notice a lot of people just invest into different mutual funds and ETFs, and we're looking here at a really basic example of the fact that investing into 65 companies versus one company, we're not noticing much of a difference in our risk level. Sure, this is based on historical returns over the past 5 years, and of course, the future could hold a different story, but the more you learn about a company, the more you do your fundamental analysis, the greater chance you have of actually making strong assumptions and predictions that actually hold true. I believe what really happens when you have too many investments in your portfolio, you make it really difficult to actually create an optimal diversified stock portfolio. Again, I'm gonna go back to the point that Apple and XLK have a low correlation of 0.38. This is showing that on the downside, when there's negative returns, Apple is not dropping a lot when XLK is also dropping a lot. There's clearly a lot of companies inside XLK and a lot of technology stocks in general that fall a lot when XLK falls a lot. But finding that Apple is not really acting so similar to the technology sector is really what I'd say a gold mine. Now, this is just my opinion, But it's really fascinating to think further about this because Apple's not following many of the true characteristics of the technology sector. Imagine pairing Apple with other companies that create this low or negative correlation of negative returns. And what's happening here is because we're looking at the downside, a portfolio wouldn't be going from $10 million to $8 million or $7 million in a month or two time frame. Instead, it may go from $10 million to $9.5 million or $9 million. The drops are not as drastic when you find stocks that have negative or low correlations of negative returns. This is so important. Another thing I want to bring up is when we look at AVGO, which is Broadcom, and you can see here that Broadcom makes up one of the larger amounts of this ETF. We notice the kurtosis is 3.99. So that means it's leptokurtic. Leptokurtic means it's more peaked. When I look at the 5-year monthly return distribution for Broadcom, I see that 25 times out of 60 monthly returns over the past 5 years were between negative 1% and 6%. That is the reason why the distribution is very peaked. Now, the skew here, it's pretty much flat. It's negative 0.08, which is a slight negative skew. So there are outliers, but there's not a crazy amount of outliers that are more on the negative or positive, just a little bit more on that negative side. When we look at Broadcom, which has performed well over the past 5 years from a return perspective, we're noticing almost a 28% annualized return, but the risk has been 20.4%. To me, that's high. I don't like seeing a number above 20% for an individual stock. And if you want to look further into this, the risk-adjusted returns are on our VI $1 Million Stocks formula. You can click on the link in the description in order to access this specific formula. What's so great about this is you're getting an understanding of each individual stock, and you can plug in any stock you want into the formula and see how it's performed on a risk-adjusted return basis. If you want to analyze skew and kurtosis further, you can apply for our one-on-one program, Protect Your Wealth, where we dive deeper into specifics behind these advanced statistical measures. Finding companies like Apple in the technology sector, in other sectors, is really important, and you can use this methodology that I talked about today to find other outperforming stocks that are not highly correlated of negative returns to their sector specifically. This really helps you not have so much risk on the downside. So many investors look at both upside and downside returns when they're looking at correlation. I strongly believe that, of course, it's important to understand what's going on from a full perspective up and down, but looking at the negative returns helps you to really weed out those companies that aren't and haven't been strong investments. Because again, if we just looked at the correlation between Apple and XLK based on 5 years of monthly historical data, both upside and downside, we would have noticed that the correlation was high. It was 0.87. When we scale that back and we only look at the correlation of negative returns between XLK and Apple, we're noticing it has a 0.38 correlation. This means there's a low correlation again. Finding companies that have low correlations with their index is key. This is a secret that you can use to invest, but don't just stop there. Make sure you always do your own research. I'm not a financial advisor, and this is educational only. I'm just sharing my opinion here. Thank you so much for listening. Please make sure you like, subscribe, and rate the podcast, and listen everywhere you get your podcasts. Have a great day.